The floor is now yours.
Excellent. Well, thank you so much. And yeah, I was looking forward to doing this in person, but obviously we're all adjusting. And if it looks like I'm doing this from bed, I am in bed. I've been sort of moving around the house throughout the day as my back's been getting stiff. So thank you for understanding that. But it's an interesting time for me to join you guys and talk finances because, you know, a lot of what we do becomes relevant in sort of middle to long-term planning. But then some of it is also relevant in times of emergency. And obviously we're in a time of emergency, but some of the steps that or actions we take and decisions we make now will also impact what our middle and long-term goals look like. And I'll get into that. Please, you know, type questions, or I don't know the best way in Zoom to ask questions, but I definitely want to tailor this to what you guys are looking for. So just a little bit about Capital Good Fund. My name is Andy Posner. I'm the founder and CEO, and we are a nonprofit based in Providence. We're also what's called, actually you guys are familiar with community development financial institutions, or CDFIs probably. So we're a CDFI, and we're pretty unique in that we provide small dollar consumer loans. Also, we're talking with Boston Impact Initiative. We were moving towards closing on actually a loan to support our work in Massachusetts. It's been delayed a little bit just with everything going on. But we do loans of $300 to $25,000 for a variety of things. So on the low end, we have a payday alternative product, and we'll talk a little bit about payday lending that we call the emergency loan. And that's sort of responding to what we're facing now. And then on the other end, we do loans for vehicle purchase, energy efficiency upgrades, and also immigration. So those are the kinds of things where you're looking at middle term or taking advantage of opportunity, you know, making your home more energy efficient, maybe getting a better car so you can go to work, that kind of thing. But we also do loans for security deposit, catching up on rental utilities, buying a computer, a semester of community college. And then we also offer one-on-one financial / health coaching. So in response to COVID, I wanted to tell you about a product that we've rolled out because, you know, as you guys know, whatever the federal government's doing is not going to be sufficient to meet the need. Also, it is excluding a lot of folks, undocumented, people don't have an SSN. And I should say, you know, we don't ask, don't tell when we lend in terms of immigration status. We also are bilingual, so everything is English and Spanish. And we lend throughout 5 states, Massachusetts being one of them. So we created something called a crisis relief loan, and I will type into the chat box the link to it now. And this is available now. So the way this product works is it ranges from $300 to $1,500. And keep in mind that this is an alternative to various predatory products that I'll explain in a second. So $300 to $1,500. Has a 5% APR fixed, a 15-month term, the first 3 months of which are deferment. So there's no payments of interest or principal. It's unsecured. We report to the credit bureaus like all of our loans, so you build your credit. There's no application fee, closing fee, prepayment penalty, etc. And then you can use it for pretty much anything. We launched it about a week ago. We've already done 35. We have another 30 that are pending closing. And most of it are being used for food, rent, utilities, bills, things like that, clothing, etc. And so, you know, we wanted to create this with some special terms in response to the specific needs that people have, like no income right now. As part of that, we actually are reviewing it based on people's income and expenses as of February. So we're assuming that right now people wouldn't be able to pass an ability to pay test. So we're looking at what their financial system situation looked like pre-crisis. And that's available. The whole process can be done online. So if you have friends or family that need it, you know, you can let them know and they can apply for that. Now, this is meant to be an alternative to things like payday loans, pawn shops, rent to own, and also refund anticipation lenders. You're probably familiar with some or all of those. One of the things that's interesting about Massachusetts is that payday lending is illegal technically. So you don't have any brick and mortar payday lenders like we do have in Rhode Island, for instance. But what you do have is a lot of online lenders that quasi-legally, or probably not legally, will make loans to you. And it's a similar concept of a payday loan where it's $300 to $500, 2-week term. You know, you're going to pay it off in 2 weeks, and supposedly, but then the average person can't do it. So a $300 loan ends up costing you $700 of interest. Another thing with payday lenders is that they don't report to the credit bureaus if you're paying on time, so it doesn't help you. But if you default, it actually gets sold to collection and it hurts your credit. So we have people who've, you know, they've never missed a payment on their payday loan, but when they go to apply for a credit card or a bank loan, it means nothing, right? But that's not the only type of product we want you to be aware of. And again, just because you can get it online in Massachusetts doesn't mean it's legal. In fact, it probably isn't. So just be aware of that. You know, if you think about something like a pawn shop where you're going to pay 60% interest, and then of course you're potentially going to lose your valuables, or rent a center if you're looking to buy, you know, an appliance or something like that. All of those are very high cost products, but if you have no other options, like what are you going to do, right? So it's not that we don't understand why people do it. It's just, unfortunately, there's no one that really offers alternatives. You know, the recommendation is typically talk to your bank or credit union. I think most of you wouldn't be surprised to hear, or you may know firsthand that they don't do these types of loans, right? Banks and credit unions don't do $500 loans, and they certainly don't do them for people with no poor credit. Undocumented folks, obviously historical racism and sexism all play a part in that. So unfortunately, we have one of the only products that are available. You know, it is a difficult type of product to offer, right? I mean, we definitely have to do it as a nonprofit. It's not a sustainable product per se, but anyway. One of the things I understood that you would like me to talk about is check cashing. Is that right?
Sure, Andy, and I think there are a couple of things. And so just to add some additional just framing for this conversation, ethical check cashing is one of the needs that was identified by community members in our assembly process. So just as you're saying, there is the recognition that this service is needed, but unfortunately, current provision is extremely exploitative. So we need check cashing, but we don't need the type of check cashing that we have access to now. We need ethical check cashing. So that's one frame, and the additional frame is Ujima as a finance entity also wants to know what do we need to know to understand what it takes to create a product like yours. So we have because our frame with the needs is we are going to either finance an operator who does it elsewhere and finance them to do it where we are, or try to figure out some other way to bring this service into our community. So we do also, you talked about it being challenging in terms of its sustainability. We're after that type of information as well. Just what does it take? What are the challenges? What are the costs in creating a product like this, et cetera?
And specifically a check cashing product?
And I'll say specifically, definitely your products. So we're curious about what it took for you to set up what you have set up, and if that includes check cashing, by all means. If your products don't include check cashing, you can feel free to talk about it a little bit. But we definitely we want to kind of get a sense of what are the steps to set up something like yours, and again, just be really aware of what we need, how much does it cost, and or a similar product in the check cashing realm.
Got it. Okay, I apologize. probably what I've said so far didn't meet with what you were looking for. So I apologize. So yeah, we
No,
don't
no,
do,
it's great so far.
okay. We don't do check cashing. That is, there's a level of, so one of the challenges for us, because it sounds like you're really interested in the business model of doing these types of products. Got it. Happy to speak to that. So one of our challenges is that we're a community-based organization, or we're a community organization with no community presence. We're an online lender. Like, in fact, the only places, we have staff in 5 states, but we only see clients in person in Providence, and even then only for our financial coaching. And the reason for that is simple. It's just the numbers don't work. There would be no sustainable way for us to deliver this at any sort of scale if we had to have a brick and mortar presence. You know, I mean, if you look at the numbers of the business model of a payday lender, you know, you can figure out how big their catchment area is and how much they have to make per client. You can't do that at an equitable interest rate. So there's this constant push and pull of how you want to set these up. Now, for us, the key to make this potentially sustainable. So last year, 30% of our revenue was from interest income. And it was really interest income on our larger loans. So the way I think about it is, on a loan under $1,000, we lose money. Full stop, we lose money. Our emergency loan, for example, has a default rate of 15%. You know, the profile of somebody who can't come up with $300 today is just going to be risky. And unless you deny everyone, which, what's the point, you're going to have high default rates. On loans between $1,000 and $2,000, we start to break even. And then on loans over $2,000, we start to generate the revenue to cross-subsidize the other products. Now, last year we have a $5 million loan portfolio right now, about 1,800 active loans. For us to be self-sustaining, we have to have a $100 million loan portfolio. The goal is to get there by 2025. And, you know, one of the challenges with this type of lending is the technology. And there's kind of like different thresholds. So if you're talking about doing like less than 50 to 100 loans, active loans, you could probably get away with doing it in Excel. Anything bigger than that, though, you got to have some sort of technology platform. And all of the platforms out there are garbage. And so we've had to spend over the years about $1 million on our tech platform. You know, that's too much for our current scale, but that's to enable where we need to go, right? Particularly to do online lending, but to think, if you think about like credit reporting, payment processing, collections, all that stuff. Now, I'm curious to learn more about what you're looking to do, because it's possible that we could somehow collaborate. You know, but I also would discourage, if you're looking to do a $500 loan product, and let's say you wanted it to be done at a different interest rate or something, just have us originate it for you, honestly. I mean, again, I don't know what you're looking to do, because it just takes a long time to set all this stuff up. From a regulatory perspective, and I don't know the regulations around check cashing, but on the lending side, Massachusetts is fairly good in the sense that if you're not going to charge over 12% on loans under $6,000, you don't need a lending license. If you're doing consumer, unsecured consumer, or you can't charge more than 18% on loans over $6,000. So if you structure it that way, you don't need a lending license, which is huge because we do need one in other states, and it's a major pain. You know, and I mean, the other regs to comply with, those are fairly simple, around like Fair Credit Reporting Act and Fair Debt Collection Practices Act. I would say that if you get in the lending business, you have to report to the credit bureaus. It's a major disservice to your clients not to. I'm on the board of a nonprofit through which CDFIs report to the bureaus. It's called Credit Builders Alliance. So you would want to talk to them about getting that set up. But again, you know, we have that infrastructure, so we might be able to do that for you.
I think that's helpful. So I have a couple of follow-up questions, and And of course, kind of opening up the invite for other people to ask whatever questions they have as well. So you have a presence in Massachusetts. And so, as I said, our frame is we have a needs list. And the way we are going to try to meet the needs that community members have identified is to invest in some type of operator. So for us, kind of like practically, I guess I would say in this space, you know, anything that we did in this space, just along the lines of kind of like payday, ethical payday lending, so to speak, most likely just would kind of look like collaboration with an
Yeah.
organization like yours. If we were in and that's because you have a presence in Massachusetts. So couple of follow-up questions is if we were in the state in which you didn't have a presence, just kind of curious about what an organization like ours, what would you speculate, I guess the process would be just in terms of, for example, what they would have to be prepared to think about and invest in an operator coming to that place? That's the first question. And then the second, I know you don't have a check cashing product, but I am curious about whether or not you could speculate, since the need that has been identified has been ethical check cashing. If you could speculate on what that could look like and how that would work, could ideally work, I'd appreciate that as well.
Yeah. So let me start with the check cashing one. You know, it's an interesting question because in the universe of predatory products, it's not that bad. Now, I'm not saying it's ethical. I'm just saying that compared to some of the other things. Now, of course, it's absurd that somebody has to pay money to get their own money. That seems like something that a credit union or somebody should just be doing. And what I was going to say before you started, asking your questions was, we should just start a credit union or a community bank and run it the right way. And I've thought about that over the years because one of the and I'm sure you guys have thought about it too. One of the challenges is that, to your first question about what would you have, what should you be thinking about if you were in a state where we don't operate, North Carolina, say. And one of the challenges is, where do you come up with your capital? Because we don't take deposits. So all the money we lend out, we borrow. Now, we're a CDFI, we've attracted 2 million from Discover Bank and et cetera, et cetera. And a lot of it's very low cost capital, but it's very difficult to match the availability of the capital with your deployment of it. Our cost of funds is like 3.75. I need to raise 90 million in new capital to hit our break-even goal. I don't fully know where I'm going to get all of that, especially at those rates. So that's one of the things to think about is, okay, where do you get your capital? Because PRI or impact investment money is fantastic, or CRA-driven money. There's only so much of it, unfortunately. And impact, sort of mainstream impact investors, they don't do impact investing, right? They do regular investing that if they can say it had some impact, then great. So the only way to get real sustainable flows of cheap capital is actually to take deposits, right? Now, then you have to run a bank or credit union. And, but there are a lot of like semi-defunct credit unions that used to be attached to a labor union or a house of worship or something. And there might be a way to take over one of those. Because if you have that and you can use their license, that makes it easier to be able to do something like check cashing. If you do it as more of a standalone thing, I think you'd have to think about co-locating it with some other service delivery, either something else that generates revenue, or co-locate it with an existing nonprofit. I don't know like the specific cost structure though around the risk mitigation and how you cover for that. So, but I know I can get you an article. There's an article about a group that did it, I believe, in Northern California. So I will send you that when I find it. But yeah.
Great. Thank you, Andy. Super helpful. Does anybody have any questions? Super helpful, super interesting. Anybody have any questions? And
Yeah, I had a question. Thanks. Um, when you say that that there's a high default rate on those smaller loans, like, so the first thing I think of is then that, like, what's another way to do it? And I'm just curious, like, something like, well, first of all, I guess there's just the idea of grants for smaller amounts, but maybe that's like a whole, then just, it's like a whole different thing. But what happens if you issue a loan that has, for smaller amounts, that has a much longer repayment term with no interest for longer? Like, does that just kill your revenue, or is that something that can work? That's like a gentler loan for those smaller amounts where you know that the likelihood of default is high. And also the other, one more question is that if credit reporting is great until you don't pay, and then it's really bad. So what happens? Yeah, what happens then?
Right. So if you agree to, if you're a credit reporter, you have to report good and bad. So unfortunately, and that's true. I think about that a lot. So when it comes to, so our overall default rate's 5%, but yes, on our smaller loans, effectively we have to change to positively impact 85 people. We have to harm 15. I mean, we're not selling to collection agencies. We're not threatening anybody, but it does hurt their credit. And I don't know a way around that because you could make the terms gentler, but typically what ends up happening is that they shut off their phone, they move, they close their bank account, and we can't get a hold of them. You know, the extension of the deferment period, like with this crisis loan, we're able to do that for two reasons. One is that we actually raised grant money. Actually, so let me tell you how we structured this crisis loan on the back end. And this is probably the solution to your question. So with this crisis relief loan, we've raised $400,000 in grant money. 90% of that is going into a loan loss reserve. So, and then we're lending out $4 for every dollar in the loan loss reserve. So as long as the default rate doesn't go over 25%, we don't have any principal at risk. Moreover, our clients don't know this, and I think you'll see why we don't tell them, but if a client were at a point where we normally would write them off, we'll actually forgive the loan with the grant money. So we'll basically pay it off. And so it'll then kind of be like a grant. So it won't hurt their credit and it won't hurt our portfolio. And honestly, the reaction to this has been such that I'm suddenly realizing that this may be just the way for us to do these smaller loans, because there's no like free market approach to doing a $300 to $500 loan. I mean, like, our country's broken and no one should need that, right? So, but the responses from funders has been really great. And the concept of the leverage is really strong, right? And I think our default rate would probably be more like 10 to 15, which means that we've raised enough probably to lend out about $3 million of our own borrowed capital. Now, the question about the deferment period, that gets a little tricky, and it depends on the structure of the capital you're deploying. So if you take on debt if the money you're lending out, you owe monthly payments of interest and principal on, then it's hard for you to defer payments because then you don't have principal revolving, right? Most of our loans have annual interest and then a lump sum at maturity. So we can afford the deferment period. And actually, we have 1,850 active loans, like I said. We've already restructured 20% of those. So no questions asked, 3-month no payment plan for everyone. And we can do that because of the structure of our capital. And that's why for-profit lenders can't. And A, they're rapacious, but also their investors don't allow that kind of thing. And it's harder also to do it if you're a depository institution.
Thanks. That's great.
I have a quick question.
Mm-hmm.
Can I ask? So it seems to me like, you're under some constraints, like depending on where you get the money from, and like the lower loans don't generate revenue, you're losing money. Is there any process that you have in place given the community you serve, right? In Providence, high, 60% at least people of color, right? Is there any process that you have in place to stop loans from getting into hands of people that are not going to pay, just because you can report that to the credit agencies and generate some money that way to make up for the loans that you don't make money on? So do you have any process to stop that from happening, or not at all? Is this a new suggestion?
Yeah, no, I mean, absolutely. So we have a very robust approach to how we underwrite, how we review the applications. And that's the thing. So even like with a payday lender, they don't underwrite. I mean, if you walk in and you have a pulse, a photo ID, and a post-dated check, you're approved, right? Part of their model is they make money if only when you can't pay. In contrast, we do a residual ability to pay test, right, to make sure that you can afford the loan. And then we review things like your banking history or utility bill payment history to try to get a sense of your tendency to pay things, right? We don't look at credit on the smaller loans because, if you're a domestic violence survivor, undocumented, whatever, often your credit is harmed for reasons outside your control. But even in spite of that, we have the 15% default rate. And that's just because, again, someone who cannot come up with $300 is sort of inherently going to be, it's not a character thing. It's they're low income, there's instability, there's things going on, and you can't mitigate for that. I don't think there's a way to do this with a lower default rate. Because it's not a question of if you did financial coaching. We don't require, by the way, we do not require coaching to get a loan. And I believe strongly in that because I think that there's a certain paternalism to saying that I'll give you this money, but only if you listen to me tell you how to manage it first. I just think it comes down to people, they just can't pay. It's not really right. Like our whole philosophy is people are poor not because they don't know how to manage money, but because they don't have enough money to manage, right? But to give you an idea, we've lent out all time $10.2 million. We've charged off $500,000, so about 5%. 150,000 of that $500,000 that we've written off has been from our emergency loan, which is crazy because it's not a very big percentage of our loans all time. In fact, it's gotten to the point where when we borrow from banks, we don't use their money to make those loans because our default rate without them is only like 3.8. So it's a big challenge, right? I mean, you can see like, I don't have a good answer for it. I feel really good about these crisis loans because I know that our principal is at risk. And like I said, the client's not at risk. And maybe that's the way to go.
Thanks.
Thank you, Angel. Can I ask a couple of follow-up questions just on this last piece? I'm curious because I think even in our communities where we may have lived experience with certain situations, and we may be kind of steeped in certain kinds of some conversations, we can still find we can still find some people who kind of subscribe to a narrative of kind of like irresponsibility that underlies the need. And so I'm just curious if you track, I know you said you do vehicle loans, but do you track the kinds of things that people are seeking loans to acquire? Just curious about what that picture looks like. That's my first question. And the second is, do you engage in policy advocacy? Do you see a place for that type of role for your organization? What's your what's your perspective with regards to if you understand that people are poor because they don't have enough money? It's not necessarily individual characteristic, and you've offered some structural analyses. Does policy advocacy play a role in how you conduct your business at all?
Yeah, so as a 501c3, we're limited to how much policy advocacy we can do. It's sort of like, I think you probably know, it's like a 15% rule. So we typically pick a handful of issues on which we advocate. We've always advocated for payday loan reform in Rhode Island. We've been trying for 8 years, and then also at the federal level. We've also advocated in Rhode Island for things like increases in the sub-minimum wage for tip workers, an increase in the earned income tax credit. And then, similarly, we've at the federal level, and then we've also advocated on the Community Reinvestment Act, kind of against the proposed changes to CRA. And then also when it comes to the budget, the federal budget, we advocate for different line items around housing, increasing SNAP benefits and the like. However, I have been thinking about starting a 501c4 that would do nothing but advocacy, sort of, from the perspective of people in poverty and folks of color and, other marginalized groups. Because, I've been, obviously in this political moment, I realized that policy matters more than anything, right? So it's something I've been thinking about. Yeah.
And then just and then just kind of reflections just on what types of needs you see people.
Yeah. So we definitely, we require that the applicants specify a need. The smaller loans are typically around housing, heating, and food. And that's part of the risk. So in general, anytime someone is, anytime someone has instability, they're moving, they just lost a job, they just got a job, divorce, that increases your credit risk. And so a lot of loans that we do are something happened and I fell behind, or I need to move, and that there's just a lot of risk associated with that. And also, if you get to the point where you can't pay your rent, right, there's a lot of other things that are going on that would result in you being at that point. Also, we don't ask, but we know that we have a fair number of domestic violence survivors that end up applying for loans. A lot of them come to us through 211. And again, we don't ask, but we kind of know. And so that, I think, is also a driver of risk and a driver of the needs around that. And then there's a lot of things around technology, laptop, tablet, dental work, paying off predatory loans, things like that. And then a lot around cars, right? Vehicle repair, tires, lube job, that sort of thing. But then on a dollar basis, a lot of the loans that we do are for immigration expenses like green card, and then also energy efficiency. But so the energy efficiency is for moderate income homeowners, and that's really where we generate our revenue. I can't hear you. I don't know if you're muted.
Oh, I'm sorry. I was thinking I was pressing the unmute button and I wasn't. So I was just saying thank you very much, and just asking any other questions. We're at time, but Ciciona.
Hi. So this was definitely of interest to me. I went to a couple years ago. I went to this Christian community development organizations conference, and there was a group, I think, in Detroit. I was just curious, what other organizations or businesses are you networking with, or do you collaborate with across the country? Yeah, if you want to share any of that. Has it gone well? And if it hasn't gone well, maybe, why, or?
Yeah. So unfortunately, there are very few nonprofit consumer lenders. Most CDFIs are doing business lending or affordable housing financing and that sort of thing. The two networks that we are members of are Opportunity Finance Network and then Credit Builders Alliance. So I'm on the board of Credit Builders Alliance. They have more consumer lender members. But yeah, unfortunately, you're not going to find a lot of capital good funds around. And I think it's considered less sexy, Like, for example, even now, if you look at the federal stimulus, most of the money is going towards small business, which is fantastic, but individuals are kind of left out of it. And so I think there's less funding available for direct to consumer product delivery. You know, I mean, there's great groups like Mission Asset Fund, Innovative Changes, but they're fairly small initiatives.
Sorry, I have one more question.
Please.
So one thing we try to do with Ujima is create the time banking, this concept of time banking. It's not exactly a barter. It's not, it's more of a bank for time. You're shaking your head. So I don't know, is that something you had considered, or is that feasible even? Like to monetize somehow, I don't know.
I don't know. You know, this is the fundamental challenge I have with anything related to social enterprises. The thing that generates revenue is the thing that doesn't take the longest to do, right? And so it's really hard to find that balance. And I struggle with it with, like I was saying before, being a community organization with no community presence. I don't have a great answer for how to reconcile that. I'm very open to exploring different models like that. I think the challenge for me is always, is there a way to bring in technology to at least improve the efficiency? Because that's the name of the game here. If you're doing 100 loans a month, if you think about all the different touch points in the process, and if you think about something like time banking, if you had some sort of technology solution that could facilitate it, yeah, maybe. And I think that's a good point. Just, you know, if I'd love to find ways to collaborate. I mean, you know, if you guys can take my model and tweak it and do it, I don't really care who does it. But if there are ways that we can collaborate, I'd be interested. I'm really interested in the check cashing thing. And I wonder if there's a way to look at that, or starting a credit union. I was talking to the treasurer of Rhode Island, Seth Magaziner. He actually brought this up on Monday. And he said that if we did it, the state would commit to put deposits, you know, with the entity. So I think we could get the initial deposits. It's just the money to set up the entity. But.
Yeah, and I mean, and as an interesting aside, Ujima's origin is in studying what it would take to start a public bank, and we landed on an ecosystem of taking kind of like a mishmash of the different models that we like and putting it together in one place and in one ecosystem and seeing how that goes. But that original ambition is still there. And so the way we see that is we're building power now, and then when the right moment comes, we'll return to that public bank conversation. And we'll have a higher chance of being successful than when we were thinking about it in 2014. So it's interesting that you raised this possibility.
Yeah.
Okay, any other questions? Okay, I think that wraps us up. Thank you so much, Andy. This was fantastic. I've sent you a private chat to say, let's follow up. And I see some silent applause and thumbs up. So once again, thank you so much. This is really great.
Thank you, everyone. It was a pleasure. Stay healthy and safe.
Thanks. Okay.